Okay, good morning. It's Tuesday, April 30th. It's time for our Tuesday weekly webinar. Good to see everybody. Hope you had a great weekend. I hope you have a great week ahead of you. We're going to have our traditional format today. I promise you we're going to get to the Financial 15 segment today. Last week we had a lot of information that we went over, so we didn't quite get to that Financial 15 segment, continuing the essential financial lessons for young adults. And this week we're going to talk about the bond market, and we're going to talk about exchange traded funds and mutual funds also. So we may go a little bit over our time today, but we're going to fill it all in. Coming up, we have we're in our live Changing World of Retirement Planning class series held at Holy Family University, which is right across the street from our office. We started on Thursday. It's always good to be back in front of the classes live. We continue it tonight, Tuesday, and then we have another Tuesday class next week, and then our second Thursday class, of course, this week. So it's not too late to start if you want to get involved. And if you're listening today for the first time because you attended the classes, welcome. If you haven't done so already, hit the subscribe, like, and notification buttons on the YouTube channel when you are seeing this in YouTube, and let's get going. So I've got, some updates. I shared with you that we're going to have a change in format. Instead of having our special webinars at different times throughout the years, we're going to include a guest in one of our Tuesday morning webinars or our morning webinars as one of the monthly guests. So we're going to start with Heather Schreiber probably. So Heather is our Social Security expert, so we're going to start with her. I'm hoping in May, but we'll let you know what's coming up there. We do have the Baby Boomer Dilemma movie coming up that we're going to show in fall of the fall of 2024. I'm laughing because my notes say 2024. That's really far away. But in 2024, this fall, 2024, we're going to show the Baby Boomer, probably all at the Newtown Theater, but we're working on that. I wanted to share some headlines with you. So I've been reviewing the proposed budget that came out of the White House. I think it was mid-March. And there's some significant tax increases in there. So I'm going to spend some time on a separate webinar talking about that. But some of the highlights of that are significant increases in capital gains tax rates, elimination of Roth conversions for high income earners. We're looking at the $400,000 to $450,000 range. So that's a big one. And the elimination of the backdoor Roth contribution. Many people call it the backdoor Roth conversion, but it really is a backdoor Roth contribution. It's a way to make contributions to a Roth IRA if you exceed the phase-out thresholds. But that's been supported by the IRS for many, many years, but this proposed budget seeks to eliminate that. So what are the chances of all these tax increases and tax changes passing this time around? Who knows, really? But what I want to talk to you about and get you paying attention to is that this train is coming, folks. So we're looking at capital gains tax rates. They're talking high 40s, 44%. They're talking about significant changes and again, the ability to take advantage of things like Roth conversions if you're deemed to earn too much money. If you're just listening, I'm doing air quotes. And even that elimination of backdoor Roth contributions, which is something that many of us take advantage of while we're still working and we want to add money to your Roth IRAs. So these are not political statements, but I just want you to be aware of, even if all these proposals aren't enacted in 2025, like what's proposed, then this is coming in some variation. So good to pay attention now. The difference between what we do and what we talk about and what many other financial advisors and financial planners talk about is that we talk about the cost of tax and this tax planning. Very, very important. I want you to start paying attention to it. Now, I want to remind you of my goals for you for these webinars. I want you to be inspired to make changes. Remember, listening, the education is about learning new things, paying attention to things. Maybe there may not even be new things, but you're reminded of things that you may have forgotten. Maybe you heard it, maybe you read it. These critical items that can make a significant difference to your retirement outcome. want you to open your mind to different ideas and ways of thinking about planning and investing. I want you to be consistently educated so you feel confident in the plan and strategies that you put into place, and I want you to stay updated so you can make adjustments along the way. They're my goals for you for attending these webinars, listening to them as you do your evening walks, your runs, you're walking the dog, whatever you're doing, or joining us live here on Tuesday mornings. And I appreciate all of you who attend live. All right, so going forward with those headlines, this came from the Peter Peterson Foundation. So they did some studies, and it showed that 92% of voters, including 90% of Democrats, 96% of Republicans, want to elect leaders who will address our $34 trillion national debt that continues to increase very quickly. And also, how do voters want their leaders to handle key upcoming fiscal decisions and deadlines? 96% want to elect leaders who will reduce deficits to help lower interest rates and control inflation. 94% want to elect leaders who will deal with the debt ceiling responsibly without risking economic damage. 90% want to elect leaders who will reform the tax system to improve our fiscal outlook. 92% want leaders who will ensure tax fairness. High percentages, 90% of voters want to elect leaders who will reform the tax system to improve our fiscal outlook. We've been told for years, over year, that we're on a very challenging path. It's unsustainable. We've heard unsustainable from our own Treasury reports. And something has to be done. 90% want to elect leaders who will reform the tax system to improve our fiscal outlook, and 92% want leaders who will ensure tax fairness. 95% want to elect leaders who will strengthen Social Security to avoid automatic cuts. Everybody knows about these automatic cuts that are coming when the trust fund goes to zero. Medicare, 92% want to elect leaders who will strengthen Medicare to avoid automatic cuts that impact patient care option and cost. In my opinion, the only reason there's a difference, 92% compared to 95%, is that people aren't quite understanding that Medicare is a much larger problem than Social Security from a financial point of view. And 84% want to elect leaders who will reform Medicaid to find savings in the program. So why do I share these things with you? Again, these are not political statements. These split pretty evenly, certainly when you're talking about our national debt with Democrats and Republicans, 90% for Democrats, 96% for Republicans. What I'm sharing the reason I'm sharing these numbers with you is that our elected officials pay attention to these numbers. They pay attention to this polling data, and when it's way up in the 90s, the only one that's not in the 90s has to do with Medicaid, and that's still at 84%. So don't think for a moment that the folks in Washington aren't paying attention to what the voters want, and they're going to act accordingly. So we've been talking about, look, I've been specializing in tax-efficient planning since 2012. Since I met my mentor, Ed Slott, and everything changed for us. Everything changed for our firm. Everything changed for our clients. We've been talking about this for a long period of time, and it is coming. It is coming very, very soon, and you have to pay attention to it. When they start closing the door, I don't understand why there's conversation in this proposal about limiting Roth conversions, because that's a boon for revenue, for tax revenue. But there is discussion about that, and it is in black and white on this proposed budget. And you can look it up. And again, I'll share more in another webinar specifically about that. So there's some of the headlines, not to concern you, just to make you pay attention and make sure that you know that tax efficient planning is very, very important. That train is coming, and that window is going to be closing very, very soon. So let's go into our Slott Report. Let's talk about 401ks, 401k RMDs in the year of retirement. I'm going to share my screen here with you. So we'd like to read along with this, and this is from our friend Ian Berger. So here's a question we get asked often. Ian writes, say you retire in the year you turn 73 or in a later year, and you want to roll over your 401k funds to an IRA. Do you have to take a required minimum distribution, an RMD, before rolling over the remaining funds? The answer is yes, but at first glance, that doesn't seem right. After all, RMDs normally don't need to start until April 1st following your age 73 or April 1st following the year of retirement if if you're using the still working exception to delay RMDs. That April 1st is considered your required beginning date for RMDs. If the 401k to IRA rollover takes place before the required beginning date, why would an RMD be required? So I hope that makes sense. You turn 73. Technically, by the rules, you have until April 1st of the year following the year you turn 73. 73 is the new RMD age, right? Technically, you have until April 1st of the following year to take your first required minimum distribution, but there are exceptions, and this is one of the exceptions. It would be required because the interplay between three tax rules. First, the first funds paid to you in a year for which an RMD is required are considered part of the RMD. This is the first dollars out rule. Second, the first year for which an RMD is required is not the year of the RBD, it's the year of retirement. That is the year before the year of the required beginning date. Third, RMDs can never be rolled over. Putting all these rules together means that the first dollars received in the year you retire on or after age 73 are part of the RMD and aren't eligible for rollover. What if the RMD is rolled over? Then you have an excess IRA contribution. But that's not as bad as it sounds as long as the rolled over amount, along with earnings or losses attributable to the excess amount, net income attributable, or NIA, or withdrawn from the IRA by October 15th of the year after the year of the rollover, you won't have a penalty. Just avoid that. Make sure you're working with qualified people who understand how to manage rollovers from your retirement plan, even if you're past your RMD trigger date, currently age 73. Because you don't want to have to deal with excess rollovers, excess contributions, and have to worry about taking the money out, fixing it, having to deal with net income attributable, and having to do it by October 15th. It's a real pain in the neck that you can avoid. So here's an example that Ian gives us. The example reads, Tara participates in her company's 401k plan. She uses the still working exception to delay plan RMDs beyond age 73. In 2025, at age 74, Tara retires and wants to roll over a 401k balance of $400,000 to an IRA. She is aware that her RBD for plan RMDs is not until April 1st, 2026, so she rolls over the entire $400,000. However, because her 2025 RMD, assume $15,000, wasn't eligible for rollover, she now has an excess contribution to the IRA. Tara can fix the error without penalty by withdrawing the $15,000 along with any income attributable, right? So any growth that she has from the IRA by April 15th, 2026. Is there a workaround for Tara to avoid taking a 2025 RMD from her 401k in calendar year 2025 if she still retires that year? Yes, by keeping the 401k funds in the plan and delaying the rollover until 2026. But then she would have to take two taxable RMDs in 2026, the 2025 RMD and the 2026 RMD, before rolling over the rest of her funds. So again, required minimum distributions can get very, very confusing. The next is our Slott Report mailbag, and this comes from Sarah Brenner, our friend Sarah. My brother died in 2020 and made me the beneficiary of an IRA he inherited from my sister who died in 2017. Can I continue to stretch the payments from this inherited IRA? If not, how soon do I have to empty it? So many confusing questions about inherited IRAs. So confusing, and you'll hear it again in here, that the IRS has delayed penalties for some inherited IRAs again this year, or waived penalties, I should say. So this is from Dave. So the answer is, hi, Dave. It sounds like you are a successor beneficiary on this inherited IRA. Your brother was the original beneficiary, and he would have been eligible to use the stretch. You inherited after the Secure Act, so as a successor beneficiary, you are subject to the 10-year rule and must empty the account by the end of 2030. Under the IRS proposed regulations, you would be required to continue the annual RMDs that your brother was taking when he was the beneficiary and subject to the stretch. However, due to continued confusion over the regulations, those RMDs have been waived by the IRS for years 2021 through 2024. The IRS has handed us such a confusing basket of issues with RMDs that they've basically said for these 4 tax years, 21, 22, 23, and 24, we are waiving penalties on required minimum distributions for this group of individuals, for this only group. I went over that last week, so if you have questions about it, go talk about. You can look at the video from last week. But just for this group of individuals. So hopefully we get some clear direction on that in 2025. Next question. I'm a beneficiary of an IRA inherited from my father who died over 10 years ago. I've been taking RMDs as required. Since I am over age 70 and a half, I did some QCDs. I received proper documentation from the charities. I use tax software to prepare my taxes. It's not allowing me to recognize the QCDs. Is there a problem with my doing a QCD from an inherited IRA? Thanks for your help. The answer is there is no problem with doing a QCD from an inherited IRA, as long as you're over 70 and a half. If you are a beneficiary who is over 70 and a half, that is allowed. It is hard to say what the problem is with the tax software. There is nothing on the Form 1099-R, which the IRA custodian generates when a QCD is done, that would distinguish a QCD from any other distribution. You must claim the QCD on your tax return. Most software programs should be able to handle this. Folks, this is another example of why you should probably have a qualified CPA on your team, your retirement team, because if you're embarking on things like Roth conversions, qualified charitable distributions, and you're just counting on these software programs to walk you through it flawlessly, you could be in for a world of frustration. Okay, so I hope that was helpful. Let's talk about the markets. So what happened last week? We're talking about 4/22, April 22nd till April 26th. New home sales. I told you what the reports were that were coming in. New home sales came in last week. Sales of new homes rose a surprising 8.8% month over month, reaching the highest level since September. New home sales make up about 14% of the housing market and are based on contract signings. Housing has been volatile, and with mortgage rates rising above 7% on the 30-year mortgage again, this volatility is likely to continue. The gross domestic product we got for the first quarter, so the first quarter GDP, gross domestic product, rose at a seasonally and an inflation-adjusted annual rate of 1.6%, well below the 2.4% expected. Consumer spending on services remains solid, but spending on goods declined, contributing to that difference. The gross domestic product looks in the rearview mirror and doesn't usually get a lot of attention from investors, but a miss to the downside as economic slowdown fears are rising warranted increased scrutiny, the analyst writes. One report doesn't make a trend, but it appears higher interest rates are having an effect and growth is slowing, but remains solidly positive, which is the sweet spot the Fed is likely looking for. So they're saying we're starting to see some slowing in growth, but still trending positive. All right, then we have the PCE report, and this is the Fed favored inflation gauge. This matched estimates what they were expecting and was up 2.7% year over year, just a bit above expectations. The core PCE also rose and was up 2.8%, slightly above expectations. The 3-month annualized change in the core PCE was 4.4%. So what does all that mean? After a hot inflation reading associated with the gross domestic product, remember we just said it was higher than expected, the PCE report was not as bad as some had feared, but inflation is not moving in the right direction, and chances of a Fed cut are diminishing. So we had a conversation. We have twice a week investment committee meetings, and we were talking on Friday, and I said, surprisingly, the market's up. What's triggering this? And our analysts on the call with us, they were telling us exactly this: the discussion between the gross domestic product and the PCE, and driving, giving some confidence to the markets. Okay, so what's coming ahead here? We have the manufacturing index, another look at manufacturing sector that seems to be teetering between expansion and contraction. So we'll see where that is coming in. And then we have the Fed decision. So on Wednesday, we see what the Fed is thinking and what their direction is going to be with rising interest rates. I don't think anybody is, or interest rates. I don't think anybody is expecting a cut at this point. So no change is expected. On Friday, we have a labor report. Employment continues to be strong, and the wage component of this release will be closely watched after this week's inflation data. So let's look at the numbers. What happened with the markets last week? The Dow Jones Industrial Average was up just 0.67%, but really happy that it closed with a positive week last week. The S&P 500 was up 2.68%. The NASDAQ was up 4.23% last week, taking it to 6.33% for the year, and the S&P 500 at 7.38% for the year. The Dow Jones is just up slightly at 2.05. Actually, all global stock indices were up, ranging from a high of, looks like the NASDAQ at 4.23, and the lowest was, as I said, the Dow Jones Industrial Average. And the bond index was down again. The bonds were down 0.08%. We're going to talk about this a little bit. What I think is a really good analyst report from Riverfront. We don't hear much from them, but they have a very good report this week. But the bond index, this 7 to 9 year maturity where most people hold their bonds, you've heard me say that over and over again, is still down 3.19% for the year. And that was really telling when we just looked back, probably just at the last webinar, maybe the webinar before. The markets, the S&P 500 was down. Certainly the Dow Jones Industrial Average was down probably close to 3% at that point, and the bond market was down 3%. So both sides of that, if you have a balanced portfolio, that 60-40 portfolio, both sides of that were down. All right, now let me share with you this analyst report from Riverfront. I'm watching my time because we've got to talk about the kids today, the young adults. No offense if you're watching this and I just called you a kid, but but we got to get through that today. So Riverfront. So Riverfront's an organization. I met these guys when I was at Wells Fargo or Wachovia. They were actually Wachovia people, and they ran the investment division at Wachovia. And I can't remember if they left before or after Wells Fargo took over, but I seem to remember that they beat it out of there as fast as possible, like we did when Wells Fargo took over. But really great. We don't invest with Riverfront, and none of this conversation is about investment recommendations. It's just I want to give you an idea of what analysts are talking about and give you some clarity around what their comments mean. But these are not investment recommendations. So let me start here. Historically, investors have been able to gain valuable insight. I'm reading this report to you, and I'll comment as needed. But historically, investors have been able to gain valuable insights about the economy from the yield curve based on its shape and steepness. So they're talking about, depending on where, I'll just share this with you. So what are they talking about when they talk about the yield curve? So they have a chart here, U.S. government yield curve. So these are years. So you see 5, 10, 15, 20, 25, 30. And a typical yield curve will look something like this. All right, you get less interest for a shorter period of time that you're holding a bond. But right now it's almost completely inverted, which is upside down. So the highest yield we're getting right now, 5.4%, is on the shortest durations, money market accounts, 3-month treasury bonds. It drops down significantly as you get to year 5 here, levels out, and then peaks up again. So that's what they're talking about with a yield curve. Again, normal is this, and we've been dealing with this inverted yield curve now for some time. There's a lot of potential issues economically and for the markets on this yield curve issue, this inverted yield curve. We want normalization for this because who would take risk of, and this article talks about this a little bit, but who would invest in a 30-year bond to get lower rates? You're tying up your money for 30 years to get lower rates than you would in another part of this curve. There's people out there who do, but that's the question. So how about we just read along on this together? So I have a lot of highlighted areas here, and you'll just read along with me on this report. So historically, investors have been able to gain valuable insights about the economy from the yield curve based on its shape and steepness. The various shapes of the yield curve can be upward sloping, downward sloping, inverted, or flat. An upward sloping curve is when shorter rates are lower than longer rates. I just showed you that, and vice versa for a downward sloping curve, while a flat curve is when short and long rates yield roughly the same. Makes sense, right? Just flat. Currently, the yield incorporates all three shapes, storing the uncertainty around the path of interest rates. I thought that was interesting. So we have inversion here, we have a normalization here, and we have we have flattening here as well. And I would call this a flat too. The belief at Riverfront is that interest rates will remain higher for longer. Higher rates for longer can trick investors into thinking that they have plenty of time to remain invested for shorter-term securities like money markets. As data can change quickly, I'm only reading the highlighted sections. As data can change quickly, and given the Fed's bias towards cutting rates, we see little reason for investors to prolong the move out on the yield curve. Remember, buying bond maturities that are longer out there. So we see little reason for investors to prolong the move out on the yield curve and lock in higher rates of return. Investing in the short end of the curve introduces in reinvestment risk, as yields may be substantially lower when it is time to reinvest those proceeds from a certificate of deposit, a CD, or a bond that's matured. So what that means is if you're saying, well, geez, money market accounts are so high right now, I'm just going to put all my money in the money market accounts and short-term treasuries or one-year CDs. When it comes time to reinvest that money, at some point the interest rates are going to be lower. So that is reinvestment risk. You're not able to reinvest it at the same level you are today. So despite the Fed delaying rate cuts due to a stronger economy, we expect the economy to slow down within the next year, Riverfront writes, leading eventually to rate cuts. Maturities, I'm going to skip. Down here where it's highlighted, we see little value in adding additional fixed income exposure at the front end of the yield curve. So we want to make sure, now again, Riverfront doesn't have the benefit of our account segmentation strategy. There are reasons that we hold short-term securities. That's money you're going to spend in the next 3 years or so. We're talking about your retirement years. So, and it could be leading up to retirement too. It's the funds you're going to spend in the next 3 years or so. We want to have in short-term, readily available securities that carry little risk, if any. We're very fortunate that we're getting 5% in those short-term securities. Our target is 2%, but we'll take the higher returns where we can get it. So we see little value in adding additional fixed income. That means bonds exposure at the front end of the yield curve. As we move beyond the 2-year part of the yield curve, so 2 years and later, we see additional opportunities. We believe that maturities ranging from 3 to 10 years provide investors with the best opportunities to generate income by locking in higher yields for longer. As an asset manager that manages balanced portfolios, we believe locking in yields north of 4% for 3 to 10 years will help our clients meet their investment objectives and allow them to rely less on more volatile instruments like stocks. Now, I will say, let me interject here, I think the bond market can be much more volatile than the stock market in many areas. But again, this is not my report. I'm just sharing it with you. For example, in a 50% equity and 50% fixed income portfolio in 2020, if the investor needed it to receive an annual total return of 6%, the equity portion, that means stock, equity means stock, the stock portion of the portfolio had to return 11% when the 10-year treasury yielded 1%. So when there was that 50-50 portfolio was heavily relying on the stock return to achieve that 6% return. That's what they're saying. But now, fast forward to the present day where 3 to 10-year treasuries, or bonds issued by the U.S. Treasury, yield approximately 4.6 to 4.8%, the bond portion of the balanced portfolio will deliver more than 2 percentage points of the investor's 6% return. So it's carrying the bond portfolio, because of the yields, is carrying a heavier load portion of the allocation. Thus, by locking in current yields for longer, investors receive a better risk-adjusted return. Then it has some charts, and I don't think there's any. Oh, my goodness. Yes, there is. So beyond 10-year maturities, investors take on significantly more price volatility because the long maturities are more sensitive to changes in interest rates. So everybody, if you don't know that, so the longer, if you think of it like a seesaw, I'm seesawing my pen here if you're just listening. If you hold bonds, the maturities, the further out, the more volatility you get as interest rates. Interest rates drive this seesaw up and down. So if you think about it, the longer you hold that out there, and typically the shorter end too, but the longer you hold that out there, the more fluctuation and risk you have. Because every time interest rates tick up, bond values go down. Currently, we do not see a catalyst for yields on the long end of the curve to decline as inflation is starting to reaccelerate and show its stickiness. We believe that if inflation does continue to trend higher, the Fed will hold rates higher for longer. It's probably where we are, folks. We're probably going to be in this higher interest rates held by the Fed and higher inflation for some time. Remember, the Fed target is 2 for inflation. We're at 3.5, 3.4. The average 100-year inflation is 3.5. So my opinion is, I think the Fed's being too aggressive, but that's just my opinion. We believe that if inflation, we believe that if inflation does continue to trend higher, the Fed will hold rates higher for longer, thus alleviating the incentive for investing at the long end of the curve, investing in longer maturity bonds. Furthermore, investors are not being adequately compensated for purchasing maturities beyond 10 years due to the flat yield curve. So they're not getting any more interest for investing their money, tying up their money for a longer period of time. For example, the 30-year Treasury yields roughly 4.7%, while the 10-year Treasury yield is right around 4.6%. So it doesn't make sense what they're saying in the next sentence for that extra 10 years, you're tying up that money just for 0.1%. While our preference is in the 3 to 10 year range, it's important to recognize that long duration treasuries have a unique role to play in balanced portfolios, primarily as a shock absorber against recession and potential downside moves in the stock markets. I shared with you that I spent some time with Harry Dent, who is a really respected economist, a few months ago in Puerto Rico. And Harry is saying buy 30-year treasuries. Everything's going to hell in a handbasket. Buy 30-year treasuries. So there are different sides of this. Neither one is a recommendation on my part. I'm sharing with you some analyst reports. Conclusion of this analyst report, the fixed income market remains volatile. Fixed income equals bonds. The fixed income market remains volatile during the uncertainty surrounding the timing and the magnitude of the Fed's interest rate cuts. Thus, the front end of the curve is not appealing to us due to the reinvestment risk. We talked about reinvestment risk. That just means that you likely can't reinvest that money. At some point, interest rates are going to be lower. If the Fed goes through with cutting interest rates in 2024, as intimated by the Fed's most recent median interest projection of 4.625 by the end of the year. Hope you understand all that. Combine that with a long end of the yield curve that is not compensating investors adequately for the added risk and lack of a catalyst for significant price appreciation. Because it could be not necessarily that you're seeking yield, but you're seeking the price of those bonds to go up. But this analyst is saying they don't expect that to happen. So we believe that the 10-year Treasury, 3 to 10 year, is the sweet spot of the curve because investors reduce investment risk. They lock in higher yields for longer without tying up money for years beyond their investment time horizon. I thought that was a really good take from Riverfront. They're a well-respected organization. Again, we don't have any of our money invested with them, but I really enjoy their analyst reports. I hope that made sense on some level. I try to distill it down and help you understand it a little bit clearer. But again, this is about education, these webinars. All right, so let's get into essential lessons. We're not there yet, but I'm going to open up what I need. All right, so this is our Financial 15 segment, and we're continuing the portion that is essential financial lessons for young adults. So if this is your first time joining us on YouTube, hit that subscribe, like, and notification button. If you want to see the weekly webinar that this is the tail end of, you can go back and look at our weekly webinars on our YouTube channel or on our website. Our website is attleborowealth.com. I'll put that up there. That's attleborowealth.com. And if you have questions for us, you can email us at questions@attleborowealth.com. So back to our presentation here. Where did this presentation come from? So if you've been following along for the past several weeks, you know that I was invited to speak to my two kids' college and the honors program at the college. And they said, would you talk about financial literacy, put together a presentation? And I really enjoyed the work in putting it together, and I greatly enjoyed the feedback. I was just told that yesterday or the day before from my kids that they've gotten a lot of good feedback from kids about it and even staff, and that's great. And I again, this is about education. If I can help in any way, that would be amazing. So we talked already about debt, and we talked about banking and fees and debt costs and Then our last segment, we talked about stocks, so about growing your money in stocks. Now we're going to talk about growing your money in bonds. And isn't this convenient? Because we just read an analyst report focusing on bonds. So grow your money investments. And this is bonds. And this is what's referred to as fixed income. So people in my industry like to get really fancy. We talk about fixed income. We talk about equities instead of saying bonds and stocks. So bonds is fixed income. Equities are stocks. A bond, it is a definition of a bond. If you're just listening, a bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond can be thought of as an IOU between the lender and the borrower that includes the details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders or creditors of the issuer. So if you buy a U.S. Treasury bond that's issued by the federal government, you've lent money to the federal government. They have to pay you interest. And that interest is what you earn along the way. We're going to talk more about that. But it's just like going to a bank and borrowing money. They're lending you money. You pay them interest. You can do the same. You can lend somebody money in a bond, and they pay you interest back. And hopefully eventually give you your principal back. And this definition comes from Investopedia. You can see where it comes from right at the bottom of the screen. So if you want to go there, Investopedia is a great resource for real basic information and even some detailed information. I use Investopedia when I'm putting together my webinars all the time. So it's a great resource. And of course, this is an example only. It's not a recommendation to buy, hold, or sell a security. You're going to see this on every slide, and I can't say it enough. Investment decisions are very individualized. You should not get your investment advice from anybody on YouTube. Don't take even the education I give you as advice on YouTube. Take it as education. Let it inspire you. Let it allow you to grow. Let it allow you to make good decisions, but don't take it as investment advice. So continuing with bonds, there are two ways to grow your money with bonds. That's interest. You are the bank. You're lending your money to someone. They're paying you interest. There's also potentially a price increase. You buy a bond at $1,000 issue for a few different reasons. The bond can go up. The value of the bond can go up or it can go down. And if it goes up, you can sell that bond and then realize the price increase. So let's talk about interest. The borrower, that's the issuer, again, the federal government, or, here we're in Newtown Township here, where my office is located. Newtown Township issues bonds. We're in the Council Rock School District here where I live. The Council Rock School District issues bonds. Surely your municipality where you live or your school district where you live, and certainly the state where you live, and our federal government issues a whole lot of bonds. That's why our debt continues to increase. And as of today, April 30th, 2024, it's about $34 trillion. I'll leave that alone for now. So grow your money investments, bonds. We're talking about interest. The borrower, that's the issuer, issues a bond that includes the terms of the loan, interest payments that will be made, and the time at which the loaned funds, that's referred to as bond principal, must be paid back at the maturity date. So if you're listening during our weekly webinar just now, I was talking about maturities, 10-year maturities, 20, 30-year maturities. So there's a lot of different maturity dates that can be purchased with bonds. Typically, the shorter the maturity, the less interest you get. The longer the maturity, the more interest you get. But not today. Today, you get more interest in shorter maturities and less in longer maturities. And that's an inversion. That's upside down. Things are upside down right now. The interest payment, the coupon, that's what it's called. That interest payment is called a coupon, is part of the return that bondholders earn for loaning their funds to the issuer. That interest rate that determines the payment is called the coupon rate. So grow your money, bonds. Who issues the bonds? Governments and agencies, U.S., state, and local, schools, and corporations. So our local community college here issues bonds. That's why I use this as an example. So I forget what the number was. It was something like $15 million that they issued for renovations. Current interest rates, a 10-year U.S. Treasury. So this was as of about 45 days ago. The 10-year U.S. Treasury was at 4.39%. A 10-year municipal bond, Pennsylvania municipal bond, was at 3.39%. and the 10-year corporate bond was at 5.12%. So why do we see these variances? Why do we see these differences between the 10-year U.S. Treasury, 10-year Pennsylvania municipal bond, and a 10-year corporate bond? So the U.S. Treasury is considered the safest investment in the world. So that means that if you put your money into, you're a bond holder, so you give the federal government $1,000, let's say. They're promising to pay you back that $1,000 in 10 years, but they're paying you 4.39% interest along the way. So you'll receive your interest credits periodically along the way, and then at the end of the 10 years, they'll pay you back what they borrowed from you. The reason that you see municipal bond rates cheaper is that they're typically tax-free. So you won't pay state, local, and tax on those municipal bonds. So they're typically a notch below what you see in taxable. So the U.S. Treasuries are taxable bonds. Corporate bonds, that's and again for the same 10-year duration. For corporate bonds, you see 10-year corporate bonds are at 5.12%. The reason that we'll see on average a corporate bond being higher percentage than a U.S. Treasury or Pennsylvania municipal bond or any state municipal bond is because there's additional risk involved. We know that U.S. Treasuries, Pennsylvania, the state of Pennsylvania, the state of New Jersey, state of California, whomever, local municipalities, local school districts are taxing authorities. So there's less risk that they're going to default. Corporations, it's based on earnings. There's no taxing authority, so you get paid more interest for that additional risk that you're taking, even though the duration is the same. That 10 years that we're seeing here, I don't know if I can draw on this. I can't draw on that. Oops, is the same. I hope that makes sense. So they're different examples of different risks. Very, very safe investment in the U.S. Treasury, but 100% taxable. 10-year Pennsylvania, for example, Pennsylvania could be any state municipal bond, but that Pennsylvania is 3.39, still considered a safe investment. You got to, there's a lot more that goes into it with states, but is considered tax free. Now it's not completely tax free. There are things that tax free interest or interest from municipal bonds create taxation, Social Security, things like that, but fundamentally, it's considered tax-free. It's not completely tax-free, though. But the 10-year corporate bonds, again, additional risk because you're basing it on the paying abilities of a corporation, not of a municipality, a government agency, a taxing authority. So that's how you increase you grow your money by interest. Now, what about price increases? If you buy a 10-year bond issued for $1,000 at 4% today, so if you're getting 4% for a 10-year bond that's issued at $1,000 today, and then next month, that same issue, say it's U.S. Treasury, say interest rates come down, that same 10-year bond, and the U.S. government issues a 10-year Treasury again next month, that same bond is issued same $1,000, but you're only getting 3.5%. That makes your bond more valuable. So now people will say, well, wait a minute. I'm pretty close to that same 10 years. I'm getting 4%. I can sell my bond. So you can actually sell your bond out on the markets and you'll make $50 in this example. So not only do you have the opportunity to earn interest, but when the price adjusts and your bond is worth more than what you paid for it, you can sell it and you can make a profit on that price increase. Now, you can also have a loss, of course. So if next month that price adjusts to 4.5%, when you look at your bonds on your statement, they're going to be worth less. And here is the example of that. So a 10-year bond issued for $1,000 today at 4% rate. If it's issued for 4.5% next month, and you had to sell your bond, you'd sell your bond for $950, so you lose $50 on that one. Again, this is an example only, not a recommendation to buy, hold, or sell a security. Now let's talk about mutual funds. So that's bonds. A lot of people invest in mutual funds. So what's a mutual fund? A mutual fund lets you pool Mutual funds let you pool your money with other investors to mutually buy stocks, bonds, and other investments. They're run by professional money managers who decide which securities to buy, stocks, bonds, etc., and when to sell them. You get exposure to all the investments in the fund and any income they generate. They offer a wide variety of investment strategies and styles, and that definition comes from Charles Schwab, and you can see where that comes from. Something that's become very, very popular lately is, in the past 15 years or so, are exchange-traded funds. So exchange-traded funds, or ETFs, are exactly as the name implies, funds that trade on exchanges, generally tracking a specific index. When you invest in an ETF, you get a bundle of assets you can buy and sell during market hours, potentially lowering your risk and exposure while helping to diversify your portfolio. Let me talk a little bit about ETFs and mutual funds. So there's been a lot of progression towards ETFs, and that's because ETFs tend to have lower fees. Lower fees are very, very important. You should be paying attention to those things when you're choosing your investments, just like when you're choosing your bank accounts and the fees associated with your bank accounts and using any credit you have and what costs are involved in those credits. Because if you just invest in mutual funds and kind of throw a dart at the board or buy the same funds, somebody who bought, they may be anywhere from, it really ranges from very low fees to very high fees. So very high fees can pull down the performance of the portfolio. So a key thing to pay attention to, a critical item when you're starting out and investing and learning about these things, is that you only pay for mutual funds that outperform. And there's a lot of good resources for that on the internet. One of them is Morningstar, and you can do some limited research on Morningstar with mutual funds. But you want to look at the cost of the fund. And again, a fund could charge you 2%, but if they're outperforming their peers and what we call a benchmark or an index that is tied to by they're charging you 2% and they're outperforming regularly by 4%, that may not be a bad fund. The problem is there are many, many mutual funds. I'm just going to go back to mutual funds since we're talking about this. That there are many, many mutual funds, just about 92% of them, who underperform or are mediocre. And you don't want to pay for underperformance. You don't want to pay for mediocre. So you've got to spend some time researching these things and looking at them and learning about it, or find a person who can help you with it. That's why many people have migrated to ETFs. ETFs can be cheap and can be efficient, but they should be both cheap and efficient. If they're cheap and they're inefficient, it really doesn't work well. If they're efficient and too expensive, it probably doesn't work well either. It oftentimes makes sense to have a blend of both mutual funds and ETFs. It's just finding the right ones. So there's a lot of detail there about finding the right ones. And frankly, that's where we spend so much time when we're developing our investment portfolios, is finding the right ones. So here are some key items. Start early. Key items, start early. I've never had anybody sit down across from the webcam or across from the table who said, gee, I wish I would have waited 5 more years. Start early. Pay yourself first. You should start with 10% of your income. That should be the number one goal. Start with that. If you can get to the 10% of your income, and then you can move it up from there, I suggest that you look up the video or read the book, The Richest Man in Babylon. It's about a 7-minute video on YouTube, but it's a really small little book if you like to read. But it has a really nice foundation of just saving and investing. So again, that's The Richest Man in Babylon. So pay yourself first, 10% of your income. You're going to pay your bills. You're going to find a way to pay your bills. You're going to find a way to pay your home. Hopefully you don't have too much debt, but you're going to find a way to do the things that you want to do and that you need to do that come out of your income. But first, you want to focus on paying yourself first. That will add up quickly over time. And by the time, if you're listening to this and you're 20 years old, 22 years old, by the time you're 40, you're going to see, maybe even before that, you're going to see the effect of just that. If that's the only thing you get out of this, 10%, pay yourself first, 10% of your income, you're going to see the effect of that. And when you see that, reach out to me and let me know that helped you. I'd love to hear that. Put as much as you can in your retirement account. If you've got a retirement account at work, this money comes out before you see it. It should probably go into a Roth option. if you have that available, but that's an individual choice and you want to look at all the pros and cons about that. But put as much as you can in your Roth account or your retirement account. Put as much as you can in your retirement account. Maximize it if you can. There is a maximum contribution level that you can do each year. Find out what that is and strive for that to be your goal and work towards that. Make it systematic and on autopilot. Whether you're saving for your retirement plan, that'll be if you're working for a company, that'll be a systematic. They'll take it automatically out of your paycheck. That's why people build up millions of dollars in their 401ks and other retirement plans, because it's done without them thinking about it. Systematic and autopilot. But even on your own, you can set up a distribution from your bank account, from your wherever your cash funds are going, to whatever investment vehicle you're using, whether it's Schwab, Vanguard, Robinhood, whatever your vehicle is. If you're sweeping over, even if it's, the beauty of today is you have things like Robinhood where you can buy, and that's not a recommendation to use them. I don't know much about them other than the fact that you can buy small portions of securities there, invest small amounts of dollars. When I first started investing, I remember calling my mother-in-law worked for an investment firm. She still works with us today, but she worked with an investment firm, and this guy was doing me a favor by buying me mutual funds and sometimes individual stocks, and always fault me about buying individual stocks. But you don't have to do that anymore. You can go online. You can set these things up on your own. You can watch them anytime, and you can find really the same research that any professional can find. It's just how to go through it. But make sure it's systematic. Make sure it's on autopilot. And consider after-tax contributions, whether it's your retirement plan, you set up an IRA. Have something where you're paying the tax now and you don't have to worry about it later, especially when you're starting early and maybe you're in a lower tax bracket and your income's low, but probably through the rest of your life. But that's a consideration you have to make with a qualified tax planner, qualified financial advisor. All right, and that is the end of that presentation. So that is the end of that series also, folks. So that is Essential Lessons for Young Adults. I'd love to hear your feedback on this. I know a lot of you listening, at least live here, are probably a little older than young adults, but I'd love to hear your feedback on that. And I'm going to potentially continue to grow this presentation and maybe do a separate course online for it. But I'd love to hear your input because you're all very wise individuals who have been at this a long time. I'd love to hear what you have to say. If you are a young adult that is just listening to this for the first time, I'd love to hear your feedback as well. Folks, that's it for today. I hope you have a great week. I hope you got something out of our time today, and I'm looking forward to seeing you next week. Take care. Bye-bye.